Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Has a bank ever told you its deposits are riskier than stocks? These should have. I shared this bold warning with Equitymaster readers in 2018. I was concerned that banks in India, particularly public sector ones, weren't being completely honest. This was a time when they had steep non-performing loans. Yet, the banks gave no warnings to their depositors. Depositors were unaware that more than half the public sector banks did not have the capital to redeem the deposits. Believe it or not, the losses of these banks were several times the value of the deposits they owed back then. And if they had to shut down, they couldn't repay the depositors. But then, as is always the case with PSUs, the government came to their rescue. Armed with emergency capital infusions from the government, the banks managed to honor deposits. This certainly did not mean better quality lending or higher provisions. So, left on their own, the PSU banks might have had to mark down the value of deposits by 90 to 100%. But with the bailout, neither the banks nor the depositors suffered. Only the taxpayers and the shareholders did. The public sector banking stocks languished for years and traded at steep discount to private sector entities. Public sector banks in India have suffered poor valuations for decades. At the turn of every economic cycle, these entities are forced to lend vigorously. They even lend to corporates with poor balance sheets. As a result, a fresh wave of NPAs clouds the profits of these entities every few years. On the other hand, private sector lender HDFC Bank is amongst a long-term investor's favorite stocks. The consistency in the lending quality, the NPA provisions and profit growth has always kept the bank ahead of the pack in valuations. When compared to even larger peers like State Bank of India, HDFC Bank's valuations are on an average at least 3 to 4 times higher. Of course, banking stocks globally are subject to pessimism from time to time. As I say this, pessimism about China's banking sector has reached an unprecedented level. Their valuations are even approaching the depths of US banks during the 2008 financial crisis. China's 4 largest banks, including Industrial and Commercial Bank of China, are currently priced at near record low valuations, about 0.4 to 0.5 times book value. This depressed level roughly matches where investors priced JP Morgan and Bank of America during the depths of 2008 crisis. The constant COVID lockdowns, departure of businesses from Chinese shores and exit of foreign investors have taken a toll. Only a sharp economic revival can turn the fortunes of the Chinese banks like they did for the American ones. Now, the banking sector in India has been enjoying massive tailwinds over the past couple of quarters as the demand for credit surged in the post-COVID phase and higher interest rates allowed the banks to fetch hefty margins without raising deposit rates. In fact, the PSU banks in India are all geared up to lend more. The third quarter of 2022 saw them grow their loan book at 18% per annum, one of the highest in decades. With lots of capex coming on stream, the banks have the mandate to offer the necessary capital. Moreover, nearly 60% of the deposits are low-cost CASA, current and savings accounts. So with bulk of rural and semi-urban deposits, PSU banks, especially SBI, have a clear cost advantage over private sector. So say you are looking for a Tata Elxsi like massive outperformer in the banking sector, you have 2 questions to answer. Would it be better to ditch the likes of HDFC Bank in favor of SBI that can without doubt reap the benefit of India's economic revival? In other words, can the stock of SBI, which has gained almost 250% since the beginning of 2020, continue to outperform HDFC Bank, which is also up about 53-54% since then? Can any private sector bank in India that is cheap and hated, like Tata Elxsi was in early 2020s during the market crash, go on to deliver massive gains? Now let us settle the PSU versus private sector debate first. Well, in my opinion, SBI and its PSU peers are currently in 2022 not as much at peril as they were in 2018, and their potential to keep lending at healthy rates is real. However, it would be foolish to assume that the government will keep perpetually bailing out the banks every few years, or that the NPAs will be soon forgotten. So do not make the decision to switch from private sector banks, say HDFC Bank, to a large PSU behemoth like SBI based on the stock's performance in recent months. Rather, take a closer look at the capital adequacy, quality of lending and return ratios. Even the private sector has several banks that have the potential for significant upside, and you would be doing yourself a huge disservice by ignoring them. For instance, Bandhan Bank, one of the newest private sector banks in India, has been treated like a pariah in an otherwise bullish sentiment for the banking sector. It almost reminds me of the stock of ITC before it became popular again in 2022. Like the tobacco business is for ITC, the microfinance business is the biggest drag on Bandhan Bank's valuations. It is also the biggest source of problems for Bandhan Bank as it is the source of NPAs. Every flood, drought or unrest in the northeastern states, especially Assam, impacts Bandhan's lending quality and recovery rate. For ITC, the turning point was the replacement of a big chunk of tobacco revenues with food and FMCG revenues. For Bandhan, the turning point can be the replacement of a big chunk of high-risk microfinance lending with low-risk retail lending. Also, like tobacco is to ITC, Bandhan's linkage to its core microlending business is decades old. Founder Chandrasekhar Ghosh started Bandhan Bank as a microcredit entity when he saw a moneylender offer Rs 500 loan to a shopkeeper at exorbitant rates. However, he used technology and doorstep service for small ticket loans to grow the business exponentially. To survive, ITC must lean on the growth prospects of the FMCG business. The regulations and tax laws regarding the tobacco business make it prohibitive for capital allocation. Similarly, Bandhan Bank's return ratios in single digits are the lowest amongst peers currently. So it must aggressively get into retail credit to fetch high lending margins at the cost of low NPAs. But if you are in a hurry to make a quick buck on the stock of Bandhan Bank, this is not for you. Remember, ITC too has over time corrected the flaws in its respective businesses. This has fetched the company better valuations. It would be extremely speculative to bet that Bandhan Bank's return ratios or NPAs will significantly improve next quarter itself. But the trend is visible. Also, since banking is a business with leverage, both upside and downside in the business prospects can get magnified. Hence, in an attempt to bag the next Tata Elxsi in the banking sector, only a long-term investing approach to make the most of the value buy should be your goal. Hope you like this video. Thanks for watching.